Still hold on to value over growth heading into 2023. Joining us now, Charlie Babrinskoy is Vice Chair of Ariel Investments, and CNBC contributor Shannon Saccocia is CIO of SVB Private. Welcome to both of you. Charlie, it's good to see you again. And you've been pounding the table. The Fed's going to make a mistake here, and I think the market is totally coming around to that point of view. So what do you make of the action the past 24 hours and as we look to head into next year?
You know, it's a little bit like watching a football game on the internet where they show the probability of win on the side. And if your team looks like they're going to win and then they throw an interception, all of a sudden that probability goes down. I have been predicting this. Have been saying the chance of a recession is modestly over 50%. I think the last number I gave you was about 70% for next year. Based on today's numbers, I got to bring that number down a little bit. The argument that we're not going to have a recession is that the consumer is in very good shape. The consumer's balance sheet is in very good shape. It's hard to go into a recession when you have a very strong labor market, and that's what we have right now. But on the other side, we still have this Fed, which I do think is highly probable of making a policy mistake. So I'm going to adjust modestly down and say the chance of a recession next year is now about 60%.
Slight tangent, but I hate those probabilities, Charlie, because we're all watching the game and then the facts change and then the prediction changes. I'm like, this prediction was worthless. It's like the Fed dots. They just tell you what you already know.
It's not worthless. As John Maynard Keynes once said, what do you do when the facts change? I change my opinion.
Fair,
what do you do, Senator? And that's what's happened here. If your quarterback throws an interception in the fourth quarter, the chance of you winning goes down a little bit. And right now, if you have great corporate earnings, the chance of a recession does go down.
Yeah, but I want him to tell me the quarterback is going to throw a interception. Shannon, let's turn to you. You're long a bunch of different stocks here, feeling, I guess, still pretty confident about the economy that Charlie's describing. Maybe he feels a little bit better about now today as well.
Yeah, I mean, I think there's sort of two sides to the story here for 2023. I think the first half of the year is going to be rather difficult, and I am not taking as much comfort, I guess you could say, in the consumer confidence number today. Consumer confidence and consumer spending are not nearly as correlated in real life as you think they would be. And so I look out over the course of the second half of the year, and even if the consumer remains robust, I worry about the rest of the components of GDP. You know, we're not going to have any sort of positive impact from fiscal spend. We're certainly not going to have any positive impact from fixed asset investment as it relates to housing. And so there's really this one sort of outstanding piece, if you will, in terms of manufacturing CapEx that could be potentially a catalyst to help support GDP growth into the back half of next year. I do worry a little bit about underestimating the long-term lagged effects of these financial conditions that we're experiencing now. And so I think with our view is that really looking at companies that have some secular tailwinds that can engineer their own growth, because I continue to think that both multiple expansion as well as margin expansion are going to be really tough to come by in 2023.
I mean, you both sound like you're a little bit singing from the same hymnal in the sense that, and everybody has to be right now. The only thing that's going to work in this environment are companies that have pricing power and moats and just good, strong businesses. But Shannon, some of the names on your list would traditionally have been thought of as growthy. Amazon, a high conviction name if it still is. Netflix, for instance. Is it because, to Charles' point, the facts have changed? Those businesses are not what they once were. Those multiples are not what they once were. And that's why you can feel comfortable owning them here?
Well, I think multiples have definitely come down, but there could be some continued compression. And certainly, you have to look at your overall portfolio. What are you willing to pay up for? Is there going to be an expectation that all of the companies in your portfolio are going to come back down to the mean? And I think that that's where there's a little bit of divergence in our view. We believe that it is going to be critical to be invested in companies that are able to grow top line absent strong GDP growth.